Right, so going back to last week's question, remember we were obviously looking at the financial records of Mahi Limited for the financial year end 29th of Feb 2020. Let's move to the next page, and we obviously got up until, or we stopped at adjustment number 7. Right, so adjustment number 7 was the asset disposal adjustment. I spent quite a bit of time on this particular adjustment, and hopefully it helped you guys revise the concepts around asset disposal. Let's now move on to adjustment number 8. Included in the February 2020 cash payments journal was a check payable to a creditor, H. Amla. The check was dated 31st of March 2020 and was for 2,300 Rand. Right, so clearly we are now coming across a post-dated check that was issued. Now remember guys, a post-dated check, a check that is made out but can only be cashed at a later date. So in this case, the creditor can only cash the check on the 31st of March 2020, obviously in the next financial year. Now, in your financial statements, more specifically in the balance sheet, this adjustment, or rather this entry that was made for the check issued, needs to be reversed. Now, what do I mean by it needs to be reversed? So remember, we issued a check, okay, so we issued a post-dated check, obviously for the 31st of March, and it was issued to a creditor. So if we go back, it would have been recorded, and correctly so, in the cash payments journal because a check was issued. The two accounts affected by this particular entry would be your bank account, and the check was issued to a creditor. So the other account affected is obviously creditor's control. Now, let's look at what we've done already in terms of the entry for this particular transaction. So obviously, if we've now issued a check, remember bank, in this particular case, I just want to quickly remind you guys, bank is a liability. Okay, so bank had a credit balance, and bank is obviously an overdraft, a liability. So if we look at our liability, when we issued the check itself, so remember bank is a liability, okay, decreases on the debit side, increases on the credit side. So obviously when we issued the check, our liability would have increased by 2,300. Remember, this entry was already made. So we credited bank, we increased, or our bank overdraft increased by 2,300, and creditors control, we decreased creditors control by 2,300 because we've made a payment to a creditor. But remember guys, what I said earlier on, this payment can only take place from the 31st of March onwards. In other words, the creditor cannot cash the check in the current financial year. It is obviously made out for the next financial year. So technically, we haven't really paid the creditor. So in our financial statements, specifically in the balance sheet, we are now going to reverse this transaction. So again, I know I'm repeating myself. What do we mean by reverse? Now that we've got the original entry, let's start off with bank. So obviously my bank account or my overdraft, although it increased by 2,300 Rand, remember that payment was not made. So in my balance sheet, I am now going to decrease my bank overdraft by 2,300. That money never really left our account, okay? Or rather, we didn't really use the overdraft for this payment as yet. Then creditors control, once again, if we look at the entry already made, we decreased creditors control by 2,300. But remember, the creditor, Amla, did not get paid. So technically, we still owe the creditor 2,300. Okay, so all I've done, I've debited bank, I've credited creditors control to explain the adjustment. But in the balance sheet, this is what we're now going to do. So let's go to our balance sheet. Right, let's quickly find the balance sheet. So I'm going to start with trade creditors, and remember what I said earlier on. Trade creditors, we are now going to increase creditors by 2,300 because that payment didn't really take place as yet. So technically we're still owing the creditor the amount of 2,300, and then our bank overdraft in the balance sheet. So if we go down to bank overdraft, our overdraft should now decrease by 2,300. Okay, quite a common adjustment, and that was one of the reasons why I spent a bit of time on this particular adjustment. Right, let's now move on to our next adjustment. So adjustment 8 completed. Let's now move on to adjustment number 9. Okay. Right, adjustment 9, the provision for bad debts adjustment reflected in the income statement under operating income was 201 Rand. Okay, so obviously provision for bad debt, something that you've come across in grade 10, grade 11, and once again in grade 12. But what I want you guys to focus on is how differently this adjustment is worded. We are not asking you to calculate the provision for bad debts by giving you a certain percentage, but instead we are telling you that in the income statement, provision for bad debts adjustment is shown under other operating income. Now, what does that mean? If it's shown under other operating income, basically it implies that provision for bad debts has decreased in the current financial year. It has decreased by 201 Rand. So I'm going to say this one more time. In the income statement, provision for bad debts adjustment is reflected under operating income. Now, the only time it will be shown under operating income is if we are expecting less bad debts in the future. So in other words, provision for bad debts has decreased. Okay, right. So how is this going to affect my balance sheet? So if I go to provision for bad debts, okay, so remember this is the old provision for bad debts, an amount of 350. This provision now decreases by 201 Rand. So my new provision for bad debts, let's quickly get our calculator out. Let's clear that, a bit of maths. So 3050 minus the 201, and that gives us an amount of 2849. So our new provision for bad debts, 2849, and this is what I now take to the actual balance sheet. So let's do that quickly. Okay, so a bit of scrolling through until we find the balance sheet. We're almost there. Okay, so there we go. Trade and other receivables, our provision for bad debts. So remember, provision for bad debts, you're going to minus, let's just quickly check, 2849. Okay, right, adjustment 9 done and dusted. Let's now move on to the rest of the adjustments. Okay, so we should be now looking at adjustment number 10. A stock count at year end revealed trading stock of 61,800 Rand. This includes all the return of stock. Now, once again, guys, please remember you are doing a balance sheet, not an income statement. So because there's no need for an income statement, it is obviously not necessary for you to now show the trading stock deficit or trading stock surplus. So very, very simple. All I'm doing is the physical stock count is what I now take to the balance sheet. Inventory total 61,800. So let's do that in our balance sheet. Okay, and we're looking at inventory 61,000, and I think it was 800. I need to now quickly go back and check. Let's just make sure that I'm doing this properly. So if we go back, 61,800. Okay, so 61,800 is our inventory amount. And as you can see, I'm not really showing whether there's a trading stock surplus or a deficit because I'm not required to do the income statement. Okay, so adjustment number 10 should have been quite simple, quite straightforward. Let's now move on to adjustment 11. Interest on loan is capitalized and was correctly recorded. During the next financial year, the total payment towards the loan, including interest, will amount to 20,000. Interest on loan for the next financial year is calculated at 8,000 Rand. Okay, so if we look at this adjustment, clearly they are not testing the calculation of interest on loan. Again, we are not required to do the income statement, so that is not being tested. What they are testing is in your ability to calculate the short-term portion of loan. Now remember, loan is obviously a non-current liability. Non-current, in other words, an amount that is owed for more than 12 months is classified as non-current. So loan generally is considered to be a non-current asset. You will take more than 12 months to pay off a loan. Right, however, every financial year you need to ask yourself how much will be paid off within the next 12 months. So remember, any amount paid within a year, within 12 months, becomes a current liability. So that is what we are now trying to establish. What is the capital portion that will be paid off within the next 12 months? So how do we calculate the capital portion? So the total repayment towards the loan during the next financial year is obviously 20,000. And remember that 20,000 will include interest as well as the capital portion towards the original loan that was borrowed. Okay, so when I say capital portion, remember it's the capital that was borrowed, the original capital amount that was borrowed from the bank. So that 20,000 includes the interest of 8,000 as well as the capital portion. Now the capital portion is not given to us, and that is the amount that we are going to show under current liability as a short-term loan. So quite straightforward for us to calculate. The total 20,000 less 8,000 will give you the amount of 12,000 that's going to reduce our loan in the next financial year. So the actual entry itself, very straightforward. So let's go to our balance sheet. And in our balance sheet, remember, under non-current liabilities, okay, so let's just go to non-current liabilities. You are now subtracting the short-term portion, which was 12,000. Okay, so that obviously makes our loan 100,000. Okay, less the 12,000, right? And that makes our loan amount 88,000. Okay, and then under current liabilities, and as you can see, there's no space, so I'm going to show it under trade and other payables. So under trade and other payables, let's quickly find the actual note. Okay, so under trade and other payables, it should be the next one. Okay, probably not. There we go. So short-term loan, and the short-term portion towards the loan, an amount of 12,000. Okay, so let's now move on to our next adjustment, adjustment number 12. The business paid, let's just get a pen out quickly. The business paid SARS 2,000 Rand more than the tax assessment for the year. Right, so let's read that one more time and let's go a bit slowly. The business paid SARS 2,000 Rand more than the tax assessment for the year. Okay, now what do we do with this information? Obviously, this is going to help us calculate our income tax for the year, as well as for us to determine whether or not SARS owes the business money. In other words, there's a debit balance, or the business owes SARS money at the end of the financial year, there is a credit balance. So remember, your income tax amount is obviously needed for the retained income note, because that amount was not given to me. And in the balance sheet under trade and other receivable, if SARS has a debit balance, but if it's a credit balance, I've got to show this under trade and other payables. Okay, let's just write that for you. So credit, trade and other payables, debit is obviously trade and other receivables. And you guys obviously know that. Right, so let's start off by calculating our income tax for the year. So in order for me to do this, I need to go back to my pre-adjustment trial balance. Let's quickly go back to the pre-adjustment trial balance. There we go. Okay, so in this pre-adjustment trial balance, and I've written it down already, SARS income tax, remember we made a payment to the receiver for an amount of 58,560. How do I know this was a payment? Because obviously the word debit implies that these were provisional payments made during the financial year. So my income tax for the year is clearly not given to me, but from the question itself, they are telling me that we overpaid SARS by an amount of 2,000 Rand. In other words, at the end of the financial year, SARS owes the business. There's a debit balance of 2,000 Rand. Now, how would I calculate my tax expense? So think about it. 58,560 minus 2,000 will then give me my income tax expense for the financial year. You can obviously reconstruct the SARS income tax account, but it's not necessary. So I overpaid the receiver. Remember, I am the business. I overpaid by 2,000 Rand. So if I now have to calculate my tax expense for the year, I'm obviously taking 58,560 minus 2,000. And that would give me my tax expense for the year. Probably didn't need a calculator for that, but let's just use the calculator in any case. 58,560 minus 2,000, and my income tax expense for the year, 56,560. And you can always double check. Okay, that's my expense for the year. That is how much I ended up paying SARS. So clearly I overpaid by 2,000 Rand. So where am I going to show this? In my retained income note. Remember, normally it wouldn't go in your retained income note, but because net profit after tax was not given to me, remember from the previous week, you were given net profit before tax. So I still need to subtract my income tax amount, and that amount is what we just calculated, 56,560. Let's just quickly double check. 56,560, and at this point I can now calculate my net profit after tax. Okay, so let's clear that. Net profit before tax, 234,460 minus the income tax amount, 56,560, and that obviously gives me 177,900. So 177,900 is my net profit after tax. Right, where do I now show the 2,000? Remember, we overpaid SARS by an amount of 2,000. So that amount would now be shown under trade and other receivables. Okay, so let's go to the balance sheet. Trade and other receivables. SARS is now owing the business an amount of 2,000. So obviously in this question, and I'm going back to last week, as you can see, we had to show all our individual amounts in brackets because the note was not required. So generally students struggle when the note is not required, but remember guys, the note is simply a vertical calculation, and when you are doing the actual balance sheet itself, here you're showing all your calculation, but this time horizontally. So if I had to tell you, for example, 10 plus 10 plus 5, okay, so clearly that is your note, and you would tell me, ma'am, the answer is 25, but you can also rewrite this as 10 plus 10 plus 5. So guys, it should not be confusing. Okay, right, I think we've got the last two adjustments to discuss, and then we can move on to some other revision. So let's now look at adjustment 13. The directors declared a final dividend of 12,000 and interim dividend or interim dividends were paid during the year. Right, so let's record our final dividend, nothing for us to calculate. Remember, your final dividend will be shown in the retained income note as well as in trade and other payable note, because a final dividend is only declared and not paid at the end of the financial year. So please guys, it's easy marks, and we find when we're marking, students often leave out trade and other payables. So please don't do that. Right, so that 12,000, let's go to trade and, before we go to trade and other payable, let's go to retained income first. So let me quickly find retained income. There we go. So dividends on ordinary shares, remember recommended is always your final dividend, and it was an amount of 12,000. Okay, and then we are also showing the 12,000 under trade and other payables, shareholders for dividends, because this amount is still owing to your shareholders, hence it's a liability, and the amount 12,000, your final dividend. Okay, right, we're down now to the very last adjustment where we're going to end up spending a bit of time because there's a buyback of shares in this particular adjustment, but we've got time, so why not make the best of it. Right, adjustment 14. Ordinary share capital comprises of the following: balance as at 1st of March 2019, 200,000. So obviously that is my opening balance. Then on the 1st of September 2019, a further 100,000 shares were issued at R2.30 each and recorded. So clearly this is an issue of shares and my share capital is going to increase. And then finally on the 1st of February 2020, the company bought back 50,000 shares at R2.40 each. This was not recorded. So I've got a buyback, and clearly a buyback decreases my ordinary share capital. So let's start off by bringing down balances, working through the shares that were issued, and then obviously we have to spend time on the buyback of shares. Right, so starting off with our opening balance, an amount of 200,000. So let's go to our balance sheet. Okay, so there we go. In our balance sheet, under ordinary share capital, in brackets, an amount of 200,000, bringing down our opening balance. This balance is now going to increase by the shares that were issued during the financial year. So let's go to that. On the 1st of September, a further 100,000 shares were issued at R2.30 each. So remember the calculation. You are simply taking 100,000 number of shares. Okay, too many zeros there. So 100,000 times R2.30. Okay, I know guys, I should probably do this without a calculator, but don't want to make a mistake. So 100,000 times R2.30, and my ordinary share capital is going to increase by 230,000. So let's fill that in. Okay, so another easy mark for me to get. So ordinary share capital increases by 230,000. Okay, right, now at this point in time, it is always beneficial. So let's just quickly go back to the adjustment. So before we get to the actual buyback, okay, so what I'm going to quickly do is I want to write down the 230,000 because that's going to help me with my calculation for buyback. Okay, so let's now tackle the last part, which obviously includes the buyback of shares. On the 1st of February 2020, the company bought back 50,000 shares at R2.40 each. This was not recorded. Right, so clearly the buyback of shares is going to impact on ordinary share capital. Okay, so it's going to impact on ordinary share capital. It's going to impact on retained income as well as on bank. Okay, right, so the buyback of shares, it was not recorded. Ordinary share capital is going to be affected. Retained income also affected, as well as our bank account. So let's start off with the bank amount, because this is the easiest one to calculate. The company bought back 50,000 shares at a buyback price of R2.40. So 50,000 times R2.40, our overdraft is now going to increase by, so 50,000 times the buyback price, R2.40, the overdraft is now increasing by 120,000. Okay, so let's deal with this first. Let's go and increase the overdraft. Remember, the company is obviously paying out shareholders and they don't have money in their bank account. Our bank account is in overdraft. So we're now going to owe the bank a further 120,000. So let's go to the balance sheet. Okay, and let's go to bank overdraft, which should be at the bottom. Let's quickly go down. Okay, so bank overdraft, our overdraft now increases by 120,000. Right, so that is out of the way. Let's now look at how our ordinary share capital and retained income is going to be affected. Right, now remember, ordinary share capital, you've got to obviously look at the number of shares that were bought back, 50,000, and calculate the average price of your shares at this point in time. So your average price of shares, remember, you are taking the total rand value of your shares. In other words, opening balance, 200,000, okay, plus the additional shares that were issued, okay, the capital amount 230,000, and you're going to then divide this by number of shares in issue. So at the beginning of the year, there were 100,000. Let's just quickly change the color. So 100,000. We then issued a further 100,000. So clearly in issue, there were a total of 100 plus 100, 200,000 shares. Okay, so that's going to give me my average price. So let's work out our average price. Okay, so we've got 200,000. I'm going to leave out the 3 zeros, plus 230,000. And then we're going to divide this by 200,000. Again, I'm just leaving out the zeros, so it makes my life a bit easy. And that gives me an average price of 2 Rand 15 cents. So 50,000 times 2 Rand 15, and my ordinary share capital is going to now decrease by, so times 50,000, it's going to decrease by 107,500. So 107,500. Just watching the time, guys, we seem to still have plenty of time. So ordinary share capital, let's go back to the balance sheet and let's now decrease our ordinary share capital by the buyback price that impacts on ordinary share capital. So minus 107,500. I just want to quickly double check that was correct. Okay, so remember guys, try and show your calculation because this would have been worth at least 3 marks, the actual amount itself. And in the event of you getting it incorrect, we're obviously looking for part marks where we can give you maybe 1 or 2 marks out of the 3. Right, and the last part, the very last part to this adjustment is your retained income. So if we look at your retained income, remember retained income again is going to decrease, as did ordinary share capital. Retained income also decreases. So 50,000 number of shares bought back times the buyback price 2 Rand 40 minus your average price of 2 Rand 15. So in other words, the amount above the average price. So let's just quickly work that out first. Okay, so obviously we're looking at 2 Rand 40 minus 2 Rand 15, and that gives us an amount of 25 cents. So 50,000 times 0,25, and my retained income will now decrease by, just quickly multiply that by 50,000. So retained income is going to decrease by 12,500. Again, because it's a buyback, your equity decreases when there is a buyback. So retained income, let's quickly go there to retained income. It should be here. And on the next line, buyback of shares, or you can call it repurchase of shares, and in brackets retained income decreases by 12,500. Okay.